Hello everyone. So today I'm going to be going over the economic break even / minimum bid price problem, just problem 1. I'll do problem 2 tomorrow. And for this first one, I'm not going to use the template because we aren't going to be given the template on the midterm. So I thought it was probably best if we did the template ourselves. So that's what we're going to do. So a dime a dozen diamonds makes synthetic diamonds by treating carbon. Each diamond can be sold for $100. So here's our first piece of information. We're going to have our sales price, right? Sales price is $100 each, so we're going to make that into a dollar sign amount. And we'll also make this slightly bigger so it's a little easier to read, and we'll just lengthen these out a bit. All right, so there we go. So the materials cost for making a diamond is $40. So that is going to be our cost of goods sold. I put that in wrong. Cost of goods sold. And that's going to be $40. We'll make that into a dollar sign as well. The fixed costs incurred each year for the factory upkeep and administrative expenses are $200,000. So these are SG and A costs. So those are selling, general, and administrative costs. And those are $200,000. Now, if you remember from the previous unit, or the previous problem we didn't include the SG&A costs that were fixed costs. And you might be like, hey, why is that? Well, in this one, there's two reasons. First, we are going to be figuring out our accounting break-even level. As well as in this one, we are talking about almost the entire company. We're not just talking about an additional product line. We are simply talking about the company as a whole. So that's why we have to include the SG&A expenses for this one, because we need to know when will we break even on our sales, not just when will we break even, on a specific, line of product. This is for the entire company. So next we have the capital purchase. So we'll just say the equipment, because we have a machine that costs $1 million, and I'm just going to guess the number of zeros. Hopefully I'm right. Yep, there we go. So we have $1 million in equipment, and this equipment has a useful life. The useful life of this equipment is 10 years. And we're going to depreciate it over a straight line basis. And the salvage value will be 0. Salvage value. Salvage value is 0. So our depreciation, I'm just going to abbreviate it. Depreciation is going to be equal to 1 million minus our salvage value divided by the number of years. And we have to add in parentheses here. Otherwise, order of operations will not let it work. So our depreciation will be $100,000 per year. So first things first, we're going to calculate our accounting break even. And we're simply going to do that by creating here we're going to zoom out, but we're going to create our own kind of income statement here. So we're going to have 10 years. So we're going to do year 1, 2, and we're going to just autofill all the way up to 10. We're going to have at the first line, we're going to have sales. The second line always is then cost of goods sold. And then we're going to have SG, and then we're going to have our gross profit, gross profit. All right. Then after our gross profit, we're going to have our SG and A expenses, our depreciation expenses, and I think that's going to be it for this. So this is going to be our EBIT, or earnings before income tax. That's going to be there. After our earnings before income tax, we're going to need to add back our depreciation. And then we are going to, oh, hold on, before that, we're going to need to move that down too, actually. We're going to have to take our taxes, and then our taxes. Oh, and then we're going to get our NOPAT right there, or and then so then depreciation add back, and then our equipment, and then tax effect. Okay, and then that'll be free cash flows. So sorry if that was a little quick, but I just wanted to get them all made up quick for us. So essentially, every income statement starts with sales, and then it subtracts cost of goods. That's what gives you gross profit. So we can just do that here. Sales minus cost of goods equals gross profit, and we'll just copy that all the way across. All these numbers should be in accounting format. Our selling, general, and administrative costs are always going to be negative C4. So we'll just input that in. So after we have our gross profit, we always need to take into account the other ones. I'm sure there's a faster way to do this than what I'm doing here, but I don't know how to do that right now. So I just went through and clicked them all. If you do know how to do it, I'd really appreciate that. I do know there's the format feature, but I'm really bad at guessing what the precise number should be. So I can't do that. Or maybe I just need to get better. Whatever. So from gross profit, we subtract our selling, general, and administrative costs. And then we always subtract our depreciation costs, once again using F4 to make it an absolute reference. So then we just copy it across. And then what we'll do is we will just sum all of these always to get our earnings before income tax. This is a little too long, but that's okay because it'll make everything else nice and much bigger. Now, the problem is that everything else did not get matched. That kind of sucks, but what can you do, I guess? So we'll just go through and click them all again. Silly. All right, so then taxes are just going, and actually we do need to get taxes, and so tax rate of 35%, tax rate 0.35, and we need to make that a percentage. And then what is our other thing? We need 10-year project life and a discount of 12%. So discount rate, also called the cost of capital. I'm sorry, I forgot that. It was 12%. So 0.12, and we'll make that a percentage as well. All right, so we forgot to bring those in, and we did just assume a 10-year life of the project. That's kind of a silly assumption. Maybe I shouldn't have done that, but it was confirmed to be true. So in this case, earnings before income taxes will always be just the taxes will always be earnings before income taxes times, times the tax rate, and that's actually wrong. So it's equals earnings before income tax times the tax rate, and we're going to make that tax rate an absolute reference, and we're going to make it negative, and we'll just pull that all the way across. And then our NOPAT will just be the sum of earnings before income taxes and the taxes that we have. Our depreciation, we just are adding back that depreciation from earlier, so this one will be positive. And actually, for now, I think we should probably stop. And actually maybe go back. But it's a little too late for that, so I guess we're going to do part 2 first. So we're going to subtract the equipment cost in year 1. We're going to get the tax effect of that equipment purchase. And actually, there is no tax effect actually at all of these equipment purchases, because the purchases will be depreciated throughout the life. And actually, this equipment purchase goes in year 0, not in year 1. We purchase it in year 0. There's no tax effect because it will be depreciated, and we'll get the tax effect later. And so then our free cash flows will just be our sum of no pat to all the way down to the very bottom. And we're going to make those an accounting number. So we'll just do that really quickly. We'll make them all nice and easy. And there. So there we go. That's our free cash flow for each year before we have sales. So we're going to need to calculate sales, and we're going to put just a sales, not price, just sales. It autofilled. So we're going to have a sales here, and this is going to be kind of our super important box. And now that we've set this whole contraption up, you might have noticed that we kind of skipped this top part. We never did anything with it. And that was on purpose, because we actually don't know what our sales and cost of goods are. They never gave us that number at the beginning. So we have to figure that out. And to do that, what we're going to do is we're going to set this, we're going to set our sales in every year equal to the sales times the sales price, which is right here. And we're going to F4 both of these. And we're just going to copy those all the way across. Right? And then we're going to do the same thing down here. And actually what we're going to do is we're just going to copy this one down. And we're going to change this to C11, but this one to C3. And then we're going to copy this all the way across. So what we're doing here is we're having this box times the sales price equals this. And we'll do that real quick by adding 10. So if we add 10 in, we get sales of $1,000 a year, cost of goods of $400 a year, and a gross profit of $600 a year. Now all of this stuff is immediately calculated for us. So this is actually super helpful, but we have to add one final thing, and that's that we're going to be trying to figure out the sales amount due to that makes it so that we have a net present value of 0. That's what it's asking for in the equation. What is the economic break-even level? And essentially the economic break-even level means that at what level will we be making the same amount, or at what level of sales will we make 0 economic profit? Will we only make as much money as we put into the project if you account for kind of the discount rate? So we're going to calculate our discount rate here. So discount rate of $12 or 12%. And then we're going to add in all of these values. And then to top it off, we always just add in our final equipment here, or our year 0. And at the end, we get that our net present value is super, super negative. And it's not very good. We want our net present value to be 0. So obviously sales have to be higher than 10 in order to do that. So how are we going to figure that out? Well, quite simply, we're just going to, and this is the simplest way. You should definitely learn how to do this. The other way is much more difficult, so just learn it. Hit what if analysis, hit goal seek, and you're going to set this cell, the NPV cell, which in our case is F16. We want to set it to the value of 0, because remember, economic break even, so we want our NPV to be 0. And we're going to do that by changing sales. We're just going to hit OK. Now, it kind of ruins our spreadsheet because the numbers are a little wonky, but we get sales equaling $6,973.95. Well, not dollars, just that many sales. So we probably want to round it up to about 697 for sales. That's probably more close to the actual sales that we want. But that's what's going to give us a net present value of 0. So now this is only half of it. We also have what is the accounting break-even level. So the accounting break-even level is much easier to do. So what we're just going to do is we're going to copy this sheet over. So we're going to hit move or copy, move to end, create a copy, and we're just going to rename this accounting. And I spelled that wrong, sorry. So with our accounting one, we're just going to get rid of taxes, get rid of no pat, get rid of depreciation, adding back, all of this stuff here at the bottom. And we're just going to do our earnings before income tax. And we want this to be equal to 0. That is our goal. We just want our earnings to be 0. So what we're going to do is we're going to hit what if analysis. We're going to hit goal seek. We're going to set that cell to 0 by changing the sales. Boom, 5,000. So our sales of 5,000 is our accounting profit. And we will just go through, we'll go back and hit economic break even kind of solutions here. And economic break even units. So the first one, 6,974. That was right for the economic break even. And then the accounting break even. Where is the accounting break even? I guess we don't see that anywhere. So I guess they don't give us an accounting break even in this one, but hopefully you all are still able to see kind of how we did this problem. Even though we never got to do or got to see if the accounting break even was right. I'm pretty sure it's correct. If it's not, it would have just been off because I didn't input tax. But the reason I did not input tax is because we were given, a couple of other, we were given the tax rate afterwards. So I didn't think it made sense to do that. But hopefully you guys enjoyed this video, and hopefully you at least learned how to do the non-accounting or the economic break-even, which is probably what we're going to be asked on the exam. And hopefully you also learned how to kind of do it by yourself using Excel and using the what if analysis. So hopefully you enjoyed this. Make sure to comment if you have any additional questions, and thank you all.